All right, so now we're on to lesson 5, and we're going to talk about cash credit. So cash credit is credit received by borrowing money from a bank and then paying it back later. So there's several types of cash credit, and the first type is going to be a personal loan. So personal loan. The loan must be paid back in equal payments of principal and interest or in a single payment. The quicker you pay it off, the less interest that you're going to pay. You can get a personal loan to buy a car, to buy furniture, to go on a trip, etc. You then use the borrowed amount as you wish. The amount, the rate, and the conditions of the reimbursement are fixed at the time of the contract. A personal loan is reimbursable in a predetermined time frame through monthly payments. Possible benefits of a loan. There are various options that allow you to obtain a loan to meet your needs. The loan is negotiable, and you can use the borrowed amounts as you wish. Potential risks of a personal loan. Since the loan is not linked to a specific purchase, if the goods are defective or if there's any other problem, example, the goods aren't delivered, the loan still must be reimbursed. It can drive you into more debt than you're able to pay back if the loan amount does not take into account your ability to repay. And it increases your monthly obligations, the more that you have to spend per month to pay it off. The second type of a cash credit is a mortgage. A mortgage is a long-term personal loan, and it's usually for a house in which the house purchased is used as a security for repayment. Payments are usually PIT, principal interest tax. The interest is charged on the outstanding balance at each payment date. Therefore, the amount of interest paid in the early payment is a very high percentage of the payment. As the principal is paid down, the interest portion of the payment becomes smaller. The loan is usually paid down over a period of 15 to 30 years. There are different types of mortgage loans, such as open or closed, that offer variable or fixed rates, and various options concerning the term, the payment frequency, and the amortization period. Basically what this means is when you take out a mortgage, your first payments that you make over the first few years, you pay mostly into the interest, because as soon as they give you the mortgage, they tell you how much you pay and how much interest altogether. So your first payments are mostly towards interest. As you work through the mortgage, you tend to pay off the interest, and then you start paying off the actual loan that you took for your house. That's what that is trying to tell you. There's lots of benefits of a mortgage. It allows you to purchase a home, right? Which would be impossible without a loan unless you're crazy rich. And it offers favorable rates. Risks of a mortgage is sometimes your monthly payments are high, and it's also a very long-term purchase. So a change in household revenue could have a negative effect on your ability to pay it back. The home is given as a guarantee on the loan, meaning that in case of non-payment, the bank could take your house. The purchased property can easily cost double than the length of the loan. It could cost double because of the length of the loan. Another type of cash credit is a personal line of credit. A personal line of credit is a one-time approved loan that you can borrow up to a prearranged limit by simply writing a check. It can be used to purchase anything. The interest rates are usually lower than credit cards. You are charged interest from the day you withdraw money from your line of credit until you pay it back. Possible benefits of a line of credit. It gives you the convenience to borrow money whenever you need. It offers flexible reimbursement methods, and it offers lower interest rates than credit cards. Potential risks could be that some people use this loan as a source of revenue, and it can force someone into more debt than he or she can afford. Right, one more type of cash credit would be a payday loan, so like easy cash, that kind of place. It's a small, short-term, unsecured loan, not necessarily linked to the borrower's payday. The loans are also sometimes referred to as cash advances, but are different from credit card cash advances. Payday loans rely on the consumer having previous payroll and employment records. If consumers can't get a loan from a bank because they're too high a risk or they need money quickly, they can borrow money from one of these institutions on site or online. There are no benefits of a payday loan place. They charge you a huge amount of interest, and they make a huge amount of money off of you. My tip would be to stay away from them, right? The risk, tremendous high interest rates. Lots of those rates are like 652%, 780%. That's crazy. Do not go to a payday loan advance place. Stay away from them. Another type of credit is a service credit. It's credit extended for services provided on a daily basis, but paid for only once a month. So for example, your telephone, your power, and your gas. Interest is the amount of money paid or earned for the use of money. So here's an example. You have a part-time job that guarantees you a specific number of hours each week. Your regular monthly earnings are $495.30, which easily exceed your monthly expenses of $185. You want to purchase a used car to increase your independence. For each of the next 12 months, you will have to pay monthly installment of $298. Decide whether it would be wise to use credit to make the purchase. State the reason or reasons for your decision. So the first thing that I would do is, my monthly expenses are $185. The car would be $298, which is $483. Now in this job, right, they make $495.30. Then my expenses would be $483, which means I would have only $12.30 left over. So for 12 months, I would have $12.30 to spend on extras or emergencies. I don't think that that's enough money. So $12.30 for extras or emergencies is not enough. I would look for a cheaper car or another job. So that is lesson 5. You now should be working through practice 5.